All right, well, staying with tech, the cost cutting continues at Amazon. The Amazon Smile charity donation program, the latest to get the axe. This in addition to continued layoffs and other money-saving measures. The Street hoping these efforts pan out in earnings. Here with more is Rohit Kulkarni, Managing Director at MKM Partners. Thank you for joining me, Rohit. So first I want to start with these layoffs that we saw. 18,000 job cuts in the US, Canada and Costa Rica, about 5% of their corporate employees. What is your take on these cost-cutting measures and whether it'll be enough to offset some of these losses?
It's a positive first step. I would put the cost-cutting measures that companies like Amazon are doing is a positive first step to essentially get the costs in line with the demand curve that they are seeing. Demand is obviously slowing down. We have seen 5 consecutive quarters of Amazon seeing softer revenues versus what Street was modeling. Q4 and Q1 could be the 6th quarter in a row. So which means this company needs to get their costs under control in line with what their demand is. And I think employee headcount is probably the last thing that a company wants to touch, particularly for a company of size and scale of Amazon with fulfillment centers, data centers, employees inside warehouses. So I think it's a good first step. Whether it helps with the overall margin profile, and that remains to be seen.
And Rohit, on that, I mean, you cut your 12-month price target to $125 from $145, pretty significant. What really prompted that? And do you see Amazon perhaps returning to better growth at some point?
The price target reduction was driven by downward revision of estimates. So we now see the company having slower growth in first half. And right now we think with macro and with other kind of organic product improvements the company is having, they could see accelerating growth in the second half. So that's kind of the first change we did. And secondly, we see the margin profile to be depressed in the first half with softer demand, and then we see slight margin improvement in the second half. So it's almost going to be like a tale of two cities of first half versus second half for Amazon. And near term, I think the stock is going to be under pressure given what is happening with the cloud computing segment. That drives the investor sentiment to a large degree. That's the growth engine, that's the profitability engine of the company, and that's the biggest negative surprise that the company gave back in October, November, where they talked about growth slowing down, and I think per our checks, the growth has stayed slow and has started to slow down even more. So yeah, price target due to a reduction in what we think the company could earn over the next 12 months, but also we like the stock here because we see the downside risk as fairly limited, maybe mid 80s, but the upside can go well beyond 125 if things go in their favor.
And we did see that slowdown in growth with AWS. It really did come as a surprise hit. What do you think went wrong with that? Is it a case of too much competition or people really pulling back on spending?
In our opinion, per our checks, it's more about kind of the COVID pull forward that's slowly digesting through the cloud spend that's happening both at Amazon, Microsoft, as well as Google. In 21, a lot of companies signed significantly large contracts with these companies, committing spend up to 5, 7, 8 years ahead, seeing what they were seeing on the internet in 21. In 22, they started to see slight slowdown in usage while their cloud bills started to stay high because of the pricing that anniversaries through Amazon. So people are starting to shift down their price tiers and shift down the amount of usage they're doing on the cloud. So right now it's more of a macro and a more of a industry trend. We think it's less of something that's exclusively for AWS. We think AWS is still the market leader, has the market share above and beyond Microsoft and Google. So I think as the industry recovers, AWS stands to gain share, stands to accelerate revenues, but I think it's a matter of time.
And Amazon, of course, also expanding its offerings with its Buy with Prime that's going to become available to third-party sellers coming up February 1st. So as you look at the spectrum here, because I know you cover a lot of tech firms, including Meta, Google, Snap, as we come into earnings season here for them, who are your top picks at the moment? How are you positioning yourself?
From an earnings standpoint, we see very limited positive catalysts for the stock coming into 1Q outlook. We see 1Q as probably the trough from a fundamental standpoint for most of these companies. Having said that, there are companies like Amazon that have probably some of the negative upcoming catalysts already priced in. As I said, there may be limited downside risks. So we like Amazon heading into earnings. We also like Meta, although a lot of catalysts for Meta are based on to what extent does the company believe that they need to reduce their operating expenses for 23. That's going to be the turning point. If they reduce the spend by a little bit more than what Street is modeling, I think the stock holds here and continues to grind higher. So those are the two names that I would flag. The rest of the names are going to be more tactical opportunities around near-term earnings, which is very hard to have conviction on.
A lot of diversity in the tech space to keep an eye on there. Rohit Kulkarni there, Managing Director of MKM Partners. Thank you for joining me.